Hey everyone, hope you're all doing well. If you're on the long side of the market, I suppose you have been. However, I am seeing some things that you should really pay attention to. We're at a situation where we have basically gone to exuberance. It's like almost even bigger than excessive bullishness. And what happens when this happens? Well, when people get this bullish, they invest all their funds, and eventually the market runs out of money, and then the only place it can go is down. So sometimes these bubble type environments can go on for a while, but there's a lot of catalysts out there that could get this thing going lower. We could see a big spike in interest rates. We could see something happen in the Middle East. And if sellers come into the market, they might have a hard time finding buyers because the buyers are pretty much filling up all their orders and they're completing their orders. And I just think it's an interesting way to start today. I saw this chart last week. Someone was sending it around on uh, Twitter or X. I think it was Trader Tom. Regardless, look how high we got. These are inflows to the S&P 500 ETF. Inflows. Okay, what happens with an inflow is just say a bunch of really large buyers show up to buy the S&P 500 ETF. Well, what the market makers will do will literally short them new shares. They create new shares because if you're an ETF market maker, you can do this, and you sell them the new shares, and those shares flow into the fund. So these are inflows. So this just shows that there has been huge amounts of money going into this, and eventually that will stop. The powder will be spent, so to speak, right? The wheat will be eaten, or whatever whatever analogy you want to use. Right alongside this, which is not surprising, if we look at the AAII, the American Association of Individuals and Investors Sentiment Survey, this is the highest we've been in at least a year, 52.9. So you can see the last time people were this bullish was at the very end of last year. Oh, actually, let's see what happened at the very end of last year. See if they were wrong then. Wait, that's the end of 21. All right, so the end of last year was right. I guess right about there. So yeah, so that reading actually came out right here. So people were very bullish. Well, I guess because we're coming off this low down here and so forth. Regardless, people are very bullish. So, and the bearish readings are very low. Historically, 31% of people are bearish. We're down to 20, which, if you think about it, that's down 33% from its average. And just about 2 weeks ago, we were at 27% bearish. So the amount of bearish investors has dropped significantly from the 6th to the 13th. It went from 27 to 19. These are pretty dramatic. This is a pretty dramatic drop there. And again, if people aren't bearish, well, you can imply that some of those people that aren't bearish are bullish. And then what do? They spend their money. And when people are when the market runs out of buyers, the only place it can go is down. So next time your waiter starts giving you stock tips, no offense to waiters, or your cab driver or your Uber driver, just remember the famous story of Joe Kennedy, the famous legend that back in the 20s he was walking to work and he got a shoe shine and the shoe shine boy gave him tips. So he went back to his office and he sold everything. And then he went short everything and then the market crashed and so forth and the rest is history. Well, he knew that if people that don't typically buy stocks, like shoe shine boys, are buying them, they're the last in the line. There's no one left to push the market higher after them. The market runs out of buyers. The only place it can go is lower. So we are getting to a point where I think something like that could happen. I think an important focus here needs to be on the bond market because our 20-year bond ETF, which we watch here, has gotten up to this resistance level. And sometimes things run off a resistance. Resistance is this big group of sellers or traders who want to sell around the same price, at or close to the same price. So sometimes some of these traders who want to sell start to notice, oh, there's other sellers lurking around. That's why the price isn't going any higher. Markets go higher because there's not enough sellers. So the buyers, the demand side, have to pay higher prices to get the sellers enticed. But when we get up to the resistance level, all of a sudden there is enough supply. There are enough sellers. All the buyers can get their orders filled without having to push the price higher. Now, some of the sellers start to think, oh boy, look at that. The price isn't going higher anymore. That must mean there are new sellers coming in the market. So I better reduce the price I'm willing to sell at so the buyers come to me because they're going to go to whoever is willing to sell at the lowest price. And you get the sellers start undercutting each other. And then sometimes you can, this is why sometimes you can sell off of resistance. And in this case, this would be pushing interest rates higher, which would be bearish for equities. So this is something to watch over here. This is an example here of how important it is to understand the charts and the psychology. And most people don't really get technical analysis. But you can see we sold off a resistance here, we sold off a resistance here, and here. There's a reason for that. It's like I just explained. Sellers get anxious, they're going to miss out, and they undercut each other. Now when you get to support, things tend to rally. This is the opposite dynamic. You get traders who want to buy, and they notice that the price is not falling anymore. Prices fall because there's not enough demand or buy orders to absorb all the sell orders or supply. So the sellers are forced to offer their shares at a discount to get the buyers off of the sidelines, and that forces the prices into a downtrend. But when we get to support, some of the people that wanted to buy notice it's not going any lower. Must be new buyers coming into the market. So they get anxious that they're going to miss out. And they start paying higher prices. It becomes like a bidding war. So we got to watch that there. It just shows you how some price levels are more important than others. You know, you don't really have to be a chart guru to see this. And what's really amazing, if you think about how gargantuan the bond market is, it's almost incomprehensible. And yet somehow all the forces in the universe come together to make it so these charts like have these perfect levels. It's pretty interesting if you ask me. All right, so outside of that, I'm paying really close attention to the financial sector. Different sectors are in the driver's seat at different times. And I think right now, over the next week or 2 weeks, it's going to be all about the financials. If this sector here starts to give way, if this ETF starts to break this 37 level, I think there's a good chance that leads to a broad market sell-off. And we can see how resistance here can become support here. This is another common phenomenon you can see on pretty much almost any chart. People sell here and then the price goes higher, and when it comes back, a lot of these remorseful sellers say, oh, I'm going to buy my shares back if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders, the level that was resistance can turn into support. So far that has happened here. But if the sellers come in and overpower this and this support breaks and we start to get a decent move lower, I think that's going to kind of spread across the broader markets. And before I go, I just want to take a quick look at here's the tech sector. Yeah, see, tech really isn't doing much. Healthcare isn't really doing much. Consumer discretionaries, it's kind of consolidating. So I think right now, let's pay attention to the financials. All right, everybody. I hope to see you soon. Thank you.